Paul, you know I love to start a segment off on the dollar, and I'm going to go right there now, as it seems to me the dollar has to be the winner this week of the currency market, up almost 1% against all of the other major currencies.
No, it's got just a beautiful chart pattern. If you're looking at the technicals, we bottomed out June, July at 50 or 95, got up to 99, bounced twice off of 97. The 50% retracement area, and we're trading higher. We've been looking at the dollar kind of as a two-step forward, one-step back currency. We probably went 2 steps back over the last month or so. But you're right, the dollar's the stronger currency here, as it has been for much of the last year or two, especially against the euro and some of the other European countries. And in part because the U.S. is still the strongest economy, and the interest rate picture here in the United States is still much better than the rest of the world. So I think you've got some wind behind your sails, or in your sails at least, when it comes to the dollar.
Yeah, Paul, it appears that the move to risk on assets earlier this week and yesterday especially really hit the yen. I was looking at the yen down 1.1% this week against the dollar. It seems as though that sort of risk-off sentiment is completely gone, at least when it comes to the yen.
Yeah, no, that's true. And you can confirm that looking at some of the other asset classes within the U.S. market. We're seeing a big rally in the industrials. We're seeing a lot of those parts of the market, the cyclicals, really doing well here. So again, it is very much a risk on, in the anticipation, as you mentioned at the top, that we're going to get a trade deal this time, maybe for sure, something signed in the next couple of weeks with China. And that's really what's giving the equity markets a boost. So you are getting that risk on profile, and it is filtering through to the currencies and giving the dollar an extra boost.
So, Paul, I'm going to talk about the pound, and for the first time in a little while, it isn't going to be about Brexit strategies. I think in this case, what really caught me was interesting is that big pound sell-off, which seems to have been caused by 2 Bank of England governors unexpectedly voting to cut interest rates due to the uncertainty over Brexit. However, those 7 remaining policymakers all voted to keep the policy unchanged, but were open to the future cut. Regardless, we're looking at the pound on a 1% decline for this whole entire week.
No, that's true, but again, expanded out a little bit, and actually the pound has been a little bit stronger as far as currencies go in the European area. We bounced nicely off of the lows maybe 3-4 weeks ago or so. So in the short term, yes, they're not hewing to the central banks around the world of cutting interest rates. So by them holding on to it, the fear is that it's not doing England any favors from an economic perspective and may slow them down a little bit. Part of the reason why, at least for in the very short run, you're seeing a weaker sterling here versus the dollar.
Yeah, so I think it's interesting to do that, taking that step back. You're absolutely correct. I think I want to flip just a little bit across that little pond there to the euro, because the euro actually got hit pretty hard here. I was just looking at the numbers, down to a 3-week low here. I guess the question ends up being, is this really a dollar move that's pushing down the euro, or is this just sort of, hey, you know what, if we're looking for some opportunity here, the euro's selling off. There hasn't been very great news out of the euro. It's been okay news, but overall a little surprised to see that selling off to its 3-week low against the dollar.
Yeah, the euro has been the weak sister, the sickly child of currencies. You go back a little bit further there too, and it's been an upper left to lower right chart. There's really been very little in the way of a bounce. It continues to sell, continues to decline. And I think that's really indicative of the negative interest rates that are pervasive in the European Union. I think there's some concern with the changing of the guard to Lagarde in the European Central Bank. What's going to happen there? Is she going to really change much from Mario Draghi? They're still very accommodative in their monetary policy. So the euro can't really find a bid at this point, and it's going to be a while, I think, before you're going to see that, requiring some economic turnaround in the eurozone, which is not yet in the offing.
So, Paul, before I go, or I let you go, I should say, I want to get your take on the Treasury markets because yesterday we saw the biggest jump in the 10-year since the day after the Trump was elected, roughly 15 basis points. The day after he was elected, we had the 20 basis point move. But we really see these yields rise along the way, and it's been occurring for a little while. I'm curious your take on this move of what was once a inverted yield curve to now a very steep one.
Yeah, we've got more of a normalized yield curve. If you want to take a look at history, history would say that when we go to an inverted yield curve, a recession is on the way. The real signal is a reversion of the yield curve back to normal. So you could say that, maybe a recession is that much closer. But I think if you look at the technical picture, you go back about 3-4 months ago, the momentum was certainly on the Treasury side, and you saw it in the U.S. market with REITs and utilities and all the interest rate sensitive parts of the market really flying. So they were been screaming for a correction at this point, and I think that's really what we're getting at this right now is more of a correction than it is a change in trend. So we're not calling for significantly higher interest rates. Although the economy is good here in the United States, it's not strong enough to really warrant significantly higher interest rates. We'll get the inflation picture next week. I think that'll confirm a lower inflation environment there too. So we're seeing it more as a correction than it is a change in overall direction.
So I got one little follow-up, and I'm going to let you go. I'm curious on your take, because I know we've been talking so much on the 10-year. Have you had any focus on the 2-year on the front end of the curve? The reason why I say that is kind of what you talked about in regards to that's the more sensitive of the various Treasury products, because of the fact that I did see CME expectations of a rate cut has taken a tremendous drop down to lower than 20%. Are you keeping an eye on the front end of that curve as well? Or are you really just sort of stuck in looking at that 10-year as sort of the main driver of what's on your radar?
No, really the short end is the main driver here because that's where the Fed is really operating, between their repo overnight, the expansion of their balance sheet, that's all happening at the front end of the curve. And you're right, with the Fed comments a couple of weeks ago, I think Chair Powell did a job of really defining for the markets, this is where we're going to be cutting rates, this is where we're going to be raising rates. So the markets are taking him at his word at this point and saying, we're well in that middle range. They're not going to change policy anytime soon.